Hey everyone, Tommy Durfler, Sam Rice here on the Lighthouse Wealth Group Spotlight podcast. Hope you are doing well today. And one of the things we're going to talk about today is market volatility. Um, and so I think this was important for us to talk about just because I think this is something that most people understand on a logical level, but not necessarily an emotional level. And so some of the things
hmm
we're going to be discussing is kind of what the mindset shift should be when thinking about market volatility. Some of the action plans we want to make sure to have during market volatility. And I think this is where a lot of people miss this, but the opportunities that are in hiding during market volatility. And so, Sam, what are your thoughts about market volatility?
Um, well, I think it's good to have a consistent plan for investing, but we shouldn't. You're thinking about a lot of things in reverse a lot of times when people seem to be scared of market volatility. That's typically we don't want to jump in, but we want to, keep our ears open and our eyes open and listen to what's going on. And if it's You know, if we're getting some short term changes, but we're long term investors, we really want to take advantage of these opportunities because a lot of times it's the only opportunities we get to really take advantage of in a year. And we only get a couple opportunities to really buy when, so to speak, you get things on sale.
Yeah, and I always like to start with, market volatility is basically just the ups and downs of the markets, the stock markets, right? And
hmm
it could be the bond market as well. But, when you start seeing these pretty significant swings one way or the other, in our world, that's what we call market volatility.
hmm
And so I think one thing that everybody understands as far as a normal retail investor goes, that the market can't do this. It can't be this perfect linear
Yeah.
line. And I think we all understand that on a logical level. I think the biggest thing for us is that when markets have drops, corrections, bear markets, even crashes, that's where I think
Yeah.
it's really hard for people to understand on an emotional level. Hey, these are actually very normal things and they're needed
hmm
things. You
Yeah.
take the late 90s of the tech boom and, you could buy basically any technology stock and do
Yeah.
extremely well. And then all of a sudden that bubble bursts and things go down to what I would say are normal valuations.
Yeah. It
And
flushes out the fluff.
exactly, it flushes that out because it can become overheated. Um, And so, you think of that as having a pretty significant fluctuation in just that sector. But the market in general, we think of it and we always talk about these averages. Oh, we average this, we average that, we average this. And I
Yeah.
think from a mindset shift, people think, well, that's what I should be getting each and every year. Because that's what
Yeah.
most investors talk about or analysts talk about is, oh, we've averaged this, we've averaged that, where I think most people tend to forget, hey, if you get a 9% average, that is not a 9%, rate of return each and every year. That's a
Right.
12% return. That's a 2% return one year. That could be a negative 5% one year. That could be a 15 or 17% return,
Yeah.
and that's what we
It's a
mean by
very good thing to
volatility.
bring up. Yeah. Yeah. When you look over 30 years, it does look like this. But, every quarter, you're going to have big ebbs and flows just depending on what's going on in the economy, the government, the world, what have you. Do we have, amazing technology breakthroughs? Do we have a war? Um, and all those ebbs and flows in between, where just like you said, you know, we shoot for, 7, 9%. That'd be great over a 30-year period. But it's just, yeah, 20 plus percent years, last couple of years. But then you got to think of what do we have in 2022? We were down 20 or 25% depending on the sector for the entire year.
Mm-hmm. Yeah. And I think one analogy that we keep in mind, especially for the practitioners, the advisors who are helping a lot of retail investors, and just families and individuals, is you don't let these short-term disruptors affect your long-term plan. And
Mhm.
so it's kind of, if you get in your car, right, and if you are at your house and you want to go on your vacation, right, or wherever you're trying to go, and it's 4, 5, 6 hours away, and you're in your vehicle, well, if you have a helicopter view of the map and you look at the fastest way to get there, you think, okay, I want to take a car, I want to drive on the road, right? But if you were to walk alongside that road the entire distance, you would see every pothole, you would see every danger, you would see cars, flying by, cutting people off. And the point I'm trying to make is you would see every single danger on that granular level. But when you look at a map, you would say, well, it would be foolish for me to walk, right? Because that would be quote unquote safer if I just didn't drive at all. That way I could avoid
Looking
all
for
those
everything,
things.
all the dangers in the
Yeah.
short term.
You could walk, but you think, okay, I'd never get to where I was going in a timely manner to enjoy, where I was trying to get to. And I think of investing and market volatility the same way. In the short term, yeah, you can see all these things that exist either way, right? They're going to exist whether you see them or not. But does
Mhm.
that prevent you from using the vehicle like a car or plane? Same thing, applies there. In that analogy, is you don't want to hit turbulence on the flight, your first hour and think, all right, let's turn the plane around. Nope, not going to do this.
Yeah. We're still going to ride those potholes, but we still need to get there in an hour.
Mm-hmm. That's right. So those things are all there. They exist. You just don't want to make a decision based on, those granular level um, events that are in the way, but you don't want those things to prevent you from getting to where you want to go.
Yeah. Or at least having a game plan for when those inevitably do happen. Um, right. We get 5% pullbacks a couple times a year, probably about 5 times a year, 3 to 5 times. You get 10% corrections, 1 to 2 times a year, and you get hit a bear market, which is 20% down every 5 years or so. And we've actually gotten two of those within the last 3 to 4 years, which is very unusual. Um, but really, just thinking if you're a constant investor and you still have a game plan for the long term, you should be almost welcoming opportunities like that, right? If I'm getting the same companies that I've had in favor for the last 5 to 10 years, and we've had two back-to-back plus 20 years in the market, we get a 20% pullback, which actually just happened in April. Um, these same companies, we're getting at 20% discounts. The worst, nothing's changed, you know, fundamentally in the company, and we're still going to own these for the next 5 years. But you should look for those as opportunities.
Well, and let's talk about that for a second. You had mentioned a stat, which I think is really, really important to talk about again. And we talked about 5% drops happened about 3 times per year. Okay, which means that the
Mm,
market will decline 5% at some point within the 12 months for a total of 3 different times. That's
yeah,
right.
like a stair step. It's a stair step. You can't just go straight up, right? We got to go up and check back.
So then the recovery of those are typically a month. So when we do see, and
Mm-hmm.
again, these are typical, these are averages,
Yeah,
um,
good point.
but what most people tend to forget is these things are going to happen and will continue to happen. It's just a lot of times when they do happen, they're not very exciting because sometimes we can get ahead of ourselves, especially when the market's doing really, really, really good, and maybe all of our investments are a little overvalued, and so you have these pullbacks, drops, corrections that says, okay, these
Mm-hmm.
really weren't the values. Let's return to the average. And so
Yep.
you look at that 5% drop. Okay, those occur 3 times a year. The recovery typically takes a month. 10% corrections are 1 to 2 times a year. The recovery period is typically 3 to 6 months. And then you have 20%, which is typically a bear market. And you have those once every about 5 years. You'll have a 20% pullback or a bear market. The recovery can be somewhere around 2 years, sometimes longer, sometimes shorter. And then you have, what we typically describe as a crash as a 30% decline. And that happens about once every 10 years. And the recovery could be anywhere from more than a few months to, a year or two, or even more. And so in 2008, we saw that where we had the market was down 50 to 60%, and it took about 4 years for that to come back to where it was. So I say all that to say, here we're students of the market. We learn and constantly see how these things happen, how long it takes to typically recover from that, and we come to know and expect these things are going to happen. So the way I describe it to a lot of people is saying, listen, these things are going to happen, but let's talk about, the flip side of that. How often is the market up? If you sit there and say the opposite of that, well, if you say, okay, well, the
more than half the year, maybe.
Yeah. And so we don't want to just look at these declines in the short term. We really want to see the potential for growth in the long term. And I think that's really important because that helps us as advisors make sure that we're explaining these things to our clients and saying, hey, listen, we know these things are going to happen at some point. And so therefore, let's plan for that. Let's discuss that. And so when these things do happen, it's not just such a shock to the system.
Yeah, it's that's part of our job is educating the clients as to potentially a new mindset of thinking. Right? If they've never had any guidance in the markets in their planning, who would know how to react unless you're very in tune with a lot of literature, studying the markets yourself, like you see with some do-it-yourselfers. But again, it's always nice to have that second set of eyes, so to speak. And obviously, we do this professionally, so that's different to a degree as well. Right. But what we see with a lot of do-it-yourselfers is they get focused in the short term, and very rarely do you come across people that do it yourself that have a long-term plan in mind.
And they're really excited about the investments, but sometimes they forget about the overall plan.
But why? Why are we doing this? And so you get so skittish when you get big pullbacks, or any pullback, what have you, or maybe you're in stuff that's a little too risky because you're getting more to the gambling side of the what ifs of some of these more speculative companies. When in many cases you don't need to take that much risk if you can just change your thinking to the market's going to have pullbacks, just like you said. These are inevitable. It's an ebb and a flow. You can't just have all this momentum and it just never peters off, right? But if we're changing our mindset to think of that as a discount and things are going on sale mindset, things that we love, then it's not going to shake you when markets take a pullback or a downturn. We're going to obviously evaluate where things are, but this is more so an opportunity in many cases. Like in COVID, so many people made potentially double their portfolios in COVID because they put extra money into the market when these companies didn't change during COVID. Just we had this crazy life event, world event that was happening all across the world, and people were able to take advantage of it. By the same, Microsoft's not going anywhere just because of COVID.
Yeah.
But we're able to take advantage, maybe put some extra cash they had on the side in the market, because it's not necessarily as much what you buy, but when you buy it, what prices you're able to attain, right? Because we look at some of these portfolios from clients that have owned some of these companies for a long, long period of time. And it's like, yeah, man, Microsoft's never going to $100 again, you know, things like that.
Well, and the other
Same
thing
thing with
too is
Netflix.
the mindset too is difficult because people have this loss aversion, right? And they think,
Yes.
okay, I had Microsoft, I owned it at $100, and now it's worth $90. I just lost $10. No, you don't lose until you absolutely sell. That's when you lost that.
That's
That
right.
makes it a real loss. In our world, we always call this what's called a temporary decline. When people say, "Oh, I lost $10," no, you don't lose until you sell. You just had a temporary decline. Emphasis on temporary.
Yeah.
And so a lot of times, same thing, with a home is if you were to have a home and all of a sudden, um,
Perfect example.
yeah, I mean, let's say
You sold it just because the market dropped,
yeah, you sold it because
but
the
you
market
still need a
dropped.
home.
Well, you still need a home, and the point is that you still own the door, you still own the house, you still own the roof. You haven't lost any of those
It's
things.
still an asset.
It's still
That's
an
right.
asset. It's still an
Yep.
asset, And so just because the real estate market goes down, you still own everything. You still own the building. You still own the land. You still own those things, right? They just had a temporary decline. And so now, being a student of the market, we know in these typical recovery periods how long we have to wait it out to come back to where you were. But a lot of people kind of take that mental accounting and say, "Oh, I had this, now I own, now it's less," and that can really get to you and disrupt your long-term thinking because now it's, "Oh no, what if it goes to this? What if it keeps going down?" And that's when the emotions play havoc.
Yeah. That's why it's good to have a second set of eyes, another person to take account for and have an opinion on, talk through things.
Yeah. Well, and I think then we talk about what we call headline risk, right? Which is the news and media. And that can get
Yep.
really play into it. And one thing I really do want to emphasize on here is that news outlets are a for-profit business. Okay, let's make sure we all
Yeah.
understand that for a second. They are a for-profit business. How do they make their money? They make their money by selling advertising time on their channel. And so the more viewers they have and the bigger the audience, the more they attract people who want to advertise on their show or their channel. Okay.
How do they get that?
They get that by instilling fear because fear
Striking
sells.
headlines.
Striking headlines. If you turn on any news channel right now, every single one of them, I don't care which side you're on, every single one of them says breaking news 24/7. And that
Yep.
is to grab your attention and keep your attention because they know if they do that, they can sell more advertising time, which is higher money.
My favorite is when they use one of the market indexes, the point change instead of the percentage change as their headline. When they're like, oh my gosh, we had a 500-point drop in the index. Well, maybe that was 0.5% in one day. It's like, yeah, but 500 sounds way more drastic than 0.5%.
Mm-hmm. Those little
Yeah,
psychological factors. And so that gets
totally.
people attuned to what's going on and thinking, oh my gosh, oh my gosh, oh my gosh.
Yep.
Now, the other thing too, I want to express on this is the news and media are only covering this index, right? So stock market index is typically the S&P 500 or the Dow Jones, right? Then you have the bond index, the bond markets. And so most people are not in 100% of those markets. They're diversified. They have a little
Yep.
bit of international, they have some bonds, so a lot of times what we find ourselves doing for our clients is saying, whatever the market's doing is not duplicating what's going on in your portfolio. If we have
That's
half
right.
of your money in the S&P 500 index and the market goes down 10%, well, guess we should reasonably assume that your portfolio is probably down 5%, not
Yeah,
10%. But people are glued to that. Whatever the market's doing, my money is doing, and that's not
it's a great
necessarily
point.
the case. And people tend to forget that a lot of times. And so when we show them, hey, the market's down this, but your diversified portfolio is this. Oh, okay. Well, that makes me feel better, And
This is
so
why we're diversified.
that's why we're diversified. We don't take the same level of risk typically. Um, and so I think that's one thing a lot of people just tend to forget sometimes is that, hey, what's going on in the news and media is not necessarily what's going on inside their portfolio.
Yep. That's a great point. Yeah.
So let's talk about strategies to protect your portfolio and ultimately your sanity at the same time. I think you said something. It's staying invested, right? And so we want to make sure that we're staying invested, and that the market is a forward-looking mechanism. It's basing the prices today on what we think might happen.
Yeah.
So when there's optimism, we think things will go well and go up. So it's almost like that self-fulfilling prophecy.
Yeah.
Same thing when things are down. If consumers are more pessimistic about it, then guess what? It's a self-fulfilling prophecy to some degree. These are the emotions that are built in the market, where savvy investors and analysts and mutual fund managers, they know that, and they take advantage of these things because they know that emotions do not dictate the value of a stock. It's earnings at the day dictate the value of a stock.
Yeah. Everything else in between, that just changes the price quarterly.
Mm-hmm.
Unless you get a big news headline of a merger or something like that. And that's the other thing. I mean, there's so many factors that larger institutions use to make trading decisions. That's not
Mm-hmm.
your responsibility as a retail investor. There's job reports that come out monthly. There's inflation reports that come out monthly. If you're investing for 30 or 40 years, you can't make decisions off monthly or weekly changes in the market, or you'll go crazy.
Yeah.
I mean, and the people that are building that data, it's from the past anyway.
Mm-hmm.
So it's people reacting on something that happened a month ago.
Mm-hmm.
But people get the news today, people make short-term reactions, and it's still not even accurate of what's going on currently.
Mm-hmm. So
So,
by incorporating some of these strategies, one, staying invested,
mm-hmm.
um, limit the news. That certainly helps with your sanity more than anything. Making sure you have good asset allocation, diversification, not having all your eggs in one basket. The other thing is, are going back to the staying invested. When the market rebounds, we don't know when it rebounds until after the fact. So we talk about missing the best days in the market. Um, Missing the best days in the market is when someone takes their money out of the market or their portfolios, waits for the market to get better, and then puts their money back in. And so essentially they've just missed, the recovery. And so
The best saying on this,
mm-hmm.
if you miss the best days and you try and time that, not only you have to make two right decisions, when to get out of the market and when to get back in. And nobody can do that.
Yes.
You can make one, maybe, but you can't make two.
It's very, very difficult. And usually it's based on luck, not intention.
That's right.
So there's this, what we call the cost of missing days here. And this is done by JP Morgan Asset Management. They're one of the largest investment firms in the world. But, if you take 2003 to 2023, 20 years in the market, and if you were to initially invest $10,000 in the S&P 500, if you stayed invested that entire time, over 20 years, your money went from 10,000 to having a value of just under $65,000. If you missed the 10 best days, meaning you pulled your money out during these 10 best days during that 20-year period, your $10,000 would only equal just under $30,000 during that 20-year period.
Wow.
And if you missed the 20 best days, then your value would only be about $17,000 or just over $17,000.
Wow.
So again, the point is, by trying to be right on two of those different decisions, if you just leave it alone, you ended up with the most money. at the end of
Mm-hmm.
that 20-year period. And
By
most people
far.
don't realize that.
Yeah. No, I mean, we get phone calls about that. Hey, something's changed. Should we change everything? No, it's
Mm-hmm.
more like, hey, do you have anything sitting on the sidelines? You want to take advantage of this situation or this opportunity?
Yeah.
That's really the conversation to be had.
So what if people don't have money on the sidelines? Let's say they're retired, or they just say, hey, we're socking away as much money as we can. We don't have any extra cash laying around. What else can they do?
Yeah, there's a couple different things you can do. You can do some tax loss harvesting if you've got some regular brokerage accounts. Some of the losers turn that into a tax advantage. Um, you could do a little bit rebalancing if this is a longer term correction. You could rebalance your portfolio to put it back in waiting. I know that gets a little into it, but talk to your advisor on how to do that. um, and this could be an opportunity to be able to take advantage of some Roth conversions. If we've got a less large portfolio and less income from it, that might be an area where we can make some improvements. Um, and any estate planning strategies you might be able to take advantage of in the time being, some gifting, what have you.
Well, let's go back to tax loss harvesting a little bit. So that is when the market's down, you see more than a few of your holdings down. And obviously this would be in a non-retirement account. So you would go
Correct.
ahead, sell the stocks that are down. Uh, you do that. You wait 31 days. You buy back the stocks that you sold, and now you have a loss. Now we just talked about realizing losses. You don't want to do that. For this purpose, this is for this is a tax play, not an investment play, a tax play. So now you can basically
Just by not owning it for 31 days, you can capture that loss against your gains that you may have in the same portfolio.
That's right.
And then we rebuy the same things because we like them still. But we're just able to take advantage of a 31-day pullback in the market.
Yeah, and now you are reducing your tax exposure and tax liability.
Mm-hmm.
And because if you did nothing, you still end up where you were. But now by doing this tax loss harvesting, you end up where you were. But now you're able to reduce your tax liability, and that's huge.
Yeah, just the gains and the losses, the offset.
Mm-hmm. The other thing you mentioned is rebalancing. So let's talk about that. So what happens, if you look at, let's just say a market crash where the market is typically down more than 30%. So if you look at that, the equity portion of your portfolio is going to shrink. Meaning, let's say you had 80% of your money in stocks, right, in your
Yep.
portfolio. Well, all of a sudden that shrinks down, almost 30%.
Now maybe it's 50-50 now.
Yeah,
Maybe
it's close to
your bonds
50-50.
didn't change much. Or yeah.
Well, they increase the
Yeah.
exposure from 20 to 50, right? So you're 50-50.
Yep.
So now
Because your
to
equity's down.
increase and go back to that 80-20 is very, very difficult. So what we do is rebalance, saying, hey, no, this is not our intended portfolio allocation. We want to go back to 80-20. So you remove and you sell off 30% of the bonds, put it back into equities when it's at a low point. So you are practicing buying low, selling high, right? Your bonds got overinflated. Your equity portion was underinflated. Now, without having any new monies, you are basically putting more monies in equity. That way, by doing that, it's able to recover faster within that time frame.
Yeah. You can recapture that upside.
That's right. A lot of people don't understand the importance of that. And we've done research and calculations to show how important that is, and saying it speeds up the process of recovering your money much faster by doing that.
Yeah. I mean, if you were, 60-40 and did that in this recent 20% pullback, I know it was a very short term one. Maybe 2022 would have been an easier example because it wasn't so quick. But you would have recovered a lot quicker than have just been staying in the same portfolio and just writing it out without doing anything. And then if you do that on top of still contributing, if you're still doing that, you're still adding money to your portfolio and dollar cost averaging, still contributing each month. That's that's like a double whammy because you're still, I mean, we talked a little bit about that, is still having the same investment mindset, and if you're in that accumulation phase, still investing each month, even during pullbacks, that's really where you get the best benefit of it, because you're able to average maybe where you bought it last month at a higher price and it dropped, say it dropped 10% in 1 month. You're able to have the same investment. Maybe you're doing $500 a month. You just bought the same thing for 10% less.
Mm-hmm.
That's great. You do
I
that
love,
over
I
30
love,
years.
I love sharing that with people. I don't think most people understand that, especially if they're still working and they're putting money in their
Yeah.
401k. They do not understand. A lot of people tend to forget of, oh, wait, I am buying low. Oh, okay. I am buying more of this. You're buying more shares, right, of what you
Yeah.
own. And I think most people tend to forget that, who are still contributing to their 401k plan, because you have to do that on a salary deferral basis. They take it out of your
Mm-hmm.
salary every, 2 weeks or so. And so when the market is going down, you are practicing that
Every two
habit.
weeks.
Most people
Yeah.
tend to forget that.
Well, and that's why even with, 401ks usually have some pretty bare bones investment opportunities, or just investments to choose from. But that's one of the biggest advantages that they can have, is you have that constant dollar cost averaging that's almost, it's forced upon you essentially. Where people don't have, an outside advisor to encourage them to do that or educate them to do that. Um, you know, Sometimes you see people even not doing a 401k, and man, if you can get some free money and contributing a little bit yourself, they get a match. Man,
Yeah.
that's the easiest no brainer.
Yeah. And of course, the last thing, just to take advantage and, talk about what we can do to take advantage of these bear markets or these pullbacks, are Roth conversions. So, Roth conversion is when you take pre-tax money and then you convert it over to tax-free growth, right? And so the consequences of doing that is you have to pay taxes at ordinary income levels on whatever amount you converted. So if you go from having an IRA of saying $50,000 and all of a sudden there's a market pullback and goes from 50,000 to 40,000, well, that would be the time to convert as much as you can over to the Roth,
Mm-hmm.
because I'm just using this as a example, not saying that you would do this all at once, but if you converted 40,000, well, if you converted 50,000 right before the pullback, then you're paying a 50,000 extra dollars in ordinary income taxes, right? So
Mm-hmm.
then if you wait till it goes to 40,000 and you convert it at 40,000, great. Now you're paying taxes on an extra $40,000 at ordinary income rates. Then as it recovers, it's recovering under the Roth umbrella. So you have that tax-free growth.
Yep.
So you're paying taxes
That's
on
huge.
40,000 rather than 50,000. And so now
Yep.
you just got $10,000 worth of tax-free growth, within a short amount of time frame.
Yep.
So
It's a big one people don't think of.
yeah. And so, I think there's a mindset shift for a lot of people that, we try to educate our clients in understanding that, hey, there's opportunities here. There are things that we can be doing to take advantage of these things. And this is really where money's made. Everybody makes
Mm-hmm.
money when the market does well. That's great. But when you get prices on sale, there's huge opportunity um, to be able to kind of fuel your wealth building.
One, just like you talked about earlier, people have recency bias. If you have two back-to-back years of 20-ish percent gains in the market, and then you all of a sudden get 5, 10, 20% pullback, people start freaking out. And it's like, well, look at the run we've had. I mean, it's got to, take a break at some point.
Yeah.
And then look what happens. It wasn't actually that long term of an effect. It was more these short term tariff negotiations, and we're back at all time highs again. And that was the quickest 20% bear market shock that we've ever had with the recovery ever.
Yeah.
It lasted about a month and a half, down 20%, back up to where we were, and plus some, where
Mm-hmm.
we are now.
So,
Crazy.
So as we kind of wrap up here, I think the biggest reason for this podcast and this episode was to show that there are definitely opportunities when these things happen. They're not fun. We get it, especially for retirees when you're not collecting a paycheck anymore. But we want to be able to turn these things around and say, hey, there are opportunities. Let's go ahead and make lemonade when the market hands us lemons. So,
That's right.
I think volatility is always going to be a part of this game. It's always going to be around. It's something that we can't prevent. We can only manage. So volatility is normal. A plan is power, and chaos creates opportunity. So,
I said it better myself.
with that being said, we appreciate everyone. Please like and subscribe, and we'll see you next time on the Lighthouse Wealth Group podcast, The Spotlight. Take care.
See you next time.